a big tick of approval here. They are in a very, very strong financial position on their balance sheet in particular. Hi everyone, if you're new, well, I'm glad you found my channel. What I'm trying to do here is explain that investing in the stock market is more than just buying a company you love and that's it, and thinking it's just going to go up forever. There are a lot of people who are going to get crushed by this mentality. I'm trying to help you avoid it. Now, my strategy is to look at the investment based on its financials, just like we would if we wanted to buy the entire company and run it ourselves. So just follow along to learn how to do this yourself. Plus, we will have a target buy price by the end of the video. It's part art and part science anyway, and the more practice we do, the better we're going to get. Now, if you do actually get any value out of this video, make sure to hit the like button for me so I can get some feedback. Okay, now as you've obviously seen by the title of this video, we're looking at Facebook today. So I'm going to do quite a quick valuation of it. I'm going to go through a 9-point checklist and then give you my opinion at the end to see whether we should dive into this a lot deeper. Some very basic facts about Facebook is that they have Instagram and WhatsApp, not just Facebook. It's already a $1 trillion market cap company. That's massive. And look, I think there's just so many different ways they can monetize all the data they're collecting from all these different programs. There's probably a long runway here that they have still in front of them, even though they are $1 trillion. So first thing I want to look for is the revenue growth. So to check that, it's simple. I'm just looking at revenue growing over time, and wow, it has been growing fantastically. So from about 3 billion back in 2011 to over 100 billion today. So that is some serious revenue growth. We can give that definitely a big tick. The next thing I want to look at is the gross margins. So the higher this number, the higher this percentage of gross margins, and if it's growing in particular, it means they have a competitive advantage. If they didn't have a competitive advantage, competitors would be coming in and everyone would have to be competing on price, and that would make their margins go down. So to see that they have a competitive advantage, we want to see these gross margins high and stable, and gross margins are well over 80% here and stable. They were sort of high 70s back in the about 7 or 8 years ago, and it's 81% now. It's fine. That is massive. Anything over 40% is strong. 80% is incredible, obviously, because it doesn't cost them a lot of money to make money. They just sell advertising space on Facebook and Instagram and things like that. So it's really a money printing machine. Again, fantastic, big tick of approval there. Return on invested capital. How good is the management team at using their profit that they're making and their free cash flow to make more money the following year? So return on invested capital is down here. Anything above sort of even 10 is pretty strong. 15 is great. Anything above 15 is what I'm really looking for. The last 5 years has been really in the 20% range. So this is fantastic return on invested capital. Yeah, this is all good so far. Let's keep moving. So I'm going to look at both short-term and long-term debt today. And the short-term debt is, well, they have $80 billion of current assets and only 14 billion in current liabilities. That is, they can easily pay off their liabilities by about 5 or 6 times. And their long-term assets compared to their long-term liabilities, they can pay everything off probably just with the cash that they have in the bank. So a big tick of approval here. They are in a very, very strong financial position on their balance sheet in particular. Okay, next up is free cash flow. This is the number we're going to use to value the company, because the free cash flow essentially is what we sort of get as owners of the company. The management team are going to use that free cash flow to buy back shares, pay out dividends, things like that. But that's sort of how the value gets returned to us. So free cash flow. Free cash flow has been growing, yes, just like the revenue has been growing from sort of $1, $2, $3 billion 7 or 8 years ago to now it looks like it's over $30 billion of free cash flow now, and that's grown, it looks like it's grown like 40% or so since even last year. So fantastic free cash flow growth here. This is looking very positive so far from Facebook. Now quickly, if you're interested in the brokerage accounts that I use Interactive Brokers and Saxo Bank. They're both stable, they both have long histories, they give you access to international markets, their fees are really low. I don't like taking the extra risk. I'm already investing in companies that are already inherently a little bit of risk anyway, and I don't want extra risk by putting my money in a brokerage account that isn't stable. So I don't want to use Robinhood or anything like that. I use Interactive Brokers in particular. That's probably my favorite. There's links in the description if you're interested. Okay, now back to the checklist. The next thing we want to look at is shares outstanding. Now, if this number is getting bigger, it's a bad thing. It means we're getting diluted. If this number is getting smaller or stable, that's a good thing. It means that the value of our ownership in the business is stable, if not getting stronger. So shares outstanding has been, let's see, it's been, the last 5 years, it was sort of 2.9, 2.9, 2.9, 2.8, 2.8, 2.8. That's pretty stable. It really hasn't changed much at all for the last 5 or 6 years. I'm happy to give that a tick. That's all I really need to see. Now, insider ownership. So we want the management team at Facebook, we want them invested in the company just like the shareholders. So the incentives are aligned. So if I have a look at the leadership team, okay, wow. I think we knew this already, but Mark Zuckerberg, he pays himself $25 million a year, but he has $134 billion worth of shares. So his net worth is tied to the stock price, not to the salary. Most of these people in the leadership team are as well. Wow. Okay, so Sheryl Sandberg has $500 million. Michael Schroepfer has 400 million. Christopher Cox, 100 million. So as you can see, there's a lot of people in the leadership team that have very strong invested interest in the company. Fantastic, that's what we want to see. Incentives are on the same page as shareholders. Next up is looking for what super investors have invested in the company. And this is a good filter to reduce me being an idiot. So if other people have already, smarter people who have decades of experience have invested in the company, well, that gives me a lot more conviction. I don't have to worry so much about my own ideas. I can copycat these guys in a little bit. So if we turn over to Data Roma, Facebook is owned by just about everybody. Pat Dorsey, Li Lu, David Tepper, these people I have a lot of respect for. These guys have been doing it for decades and have exceptional long-term returns. Who are Stephen Mandel, Seth Klarman. Wow, this list keeps getting bigger and bigger. Bill Miller, Daniel Loeb, wow, Thomas Gaynor, Prem Watsa. Okay, this is a real who's who of the value investing community here have invested in Facebook. So yeah, that's about as big of a tick as I can give for the Guru Investors section here. Now let's move to the most important part of this checklist, which is the price. Now, just because this has been an amazing company, which it is, this is one of the best companies I have nearly seen from a financials point of view, but we're not going to overpay for it, because just because it's the greatest company in the world, we don't want to pay 5 times what it's worth, because it'll take so long. Microsoft back in 2000 was a fantastic company, and it took 17 years for Microsoft to make enough money to justify beating its highest historical share price that it had been back in 2000. I don't want the same situation to happen with my investing, and I don't want the same thing to happen here with Facebook. So we need to find what it's actually worth and hopefully pay a little bit less than that if we can. So to find the value, I go over to my intrinsic value calculator, and that's free in the description as well if you want a copy of it. Now, I'm using growth rates that I have just estimated based on those historical growth rates. I've used a 20 free cash flow multiple, the free cash flow number, the shares outstanding, the total cash, the total debt. Now I've used a discount rate of 30%. Now that's insanely high. No one uses 30% that I've seen. The reason I want 30% is because if I aim for 30%, hopefully I actually get it somewhere in the 20% range. And that's what I want as my return on investment each year, somewhere in the 20s. So I aim for 30, hoping to get 20, and that's how I use build in a margin of safety. So if the price of Facebook was $123, I would be buying this up all day. But the current price is, let's have a quick look, $380. Now, I don't know what day you're watching this, but I assume it's still around this level. Now, 30% is obviously pretty crazy. Now, let's drop that back down to, I don't know, 22%. Maybe I'm only trying to get like 15%, 20% return on my money. If I aim for 22%, maybe that's probably fair. So that would say I'd want to buy this at about, we'll call it $200. Now remember, the stock price is nearly $400. So we're not really going to get a great return on investment here, I think, using these growth rates. Now, maybe we can be a little bit more aggressive and say it's going to grow at 20% per annum for the next 5 years. It's not going to grow much faster than that, I don't think. That's pretty optimistic. So I'm still only $220 with 22% ROI. That's no margin of safety, but okay, let's say 15% ROI. Again, no margin of safety, so we're probably going to get somewhere between sort of 10 and 15%. I'm still only buying it at $350 and the stock price is $380. So no matter which way we cut this, it's fair value. It's probably right on its fair value. Let's put it at 12%. Yeah, it's somewhere between 12 and 15% ROI with a 20% growth rate. So I would say it's probably fair value right now. And you're probably going to maybe get 10, maybe 15%, which is pretty good. It's probably going to beat the market. But that's not going to cut it for me. I kind of want 20%. That's sort of what I'm looking for in an investment. And I don't see that being possible here with Facebook at the moment at the current price. So I guess that leads to my overall opinion, which is it's got amazing return on invested capital metrics, just amazing financials overall. So many super investors, there is possibly maybe some hidden assets that I'm not factoring into this price. Maybe that's what they see in this investment, but I don't see this unless I went digging a lot deeper. If you do know what the hidden assets are, you can tell me in the comments, by the way. I would be very interested. But look, the market cap is so big that growth, I think, is going to be hard to grow at those 20% range. 20% still possible, but look, I don't see this being a 5-10x return at these prices over the next decade. Maybe you get 10-15%, and that's pretty good, but it depends what you're looking for. That might be fantastic, and maybe you want to just get your 10 or 15% and in a really safe company and set it and forget it for the next decade. I would be totally on board with that theory anyway. Just for me, the price is just a bit too high. Now, I do hope you've got some value out of this video. I know I look at things a little bit differently, but I do hope it is interesting in any way and you can follow along. Don't forget to give the video a thumbs up if you did get something out of it, and I will see you in the next video.